In today's class, we are going to discuss a new part in international economics that is about the growth of emerging markets like Brazil, Russia, India, and China. You might know that these four nations are together called BRIC: Brazil, Russia, India, and China. And they are said to have been the emerging market economies in the world. But later on, one more nation has been added to this list, that is South Africa. So now we have the BRICS: Brazil, Russia, India, China, and South Africa. So we will come to that aspect later on. About the BRICS, we will also be discussing something. So in this video, we are going to discuss the growth of emerging market economies and what is meant by emerging market, or what is meant by an emerging market economy, that we will also discuss. So let us start discussing the meaning of the emerging market economies. And what do you mean by an emerging market economy? An emerging market is a country that is recognized as having a significant GDP growth, as well as a large global contribution to production, an increase in the size of the middle class, and a potential for rapid growth and investment. And simply speaking, an emerging market economy is an economy which has been registering a significant GDP growth and enlarged middle class, and offering a potential for rapid growth and investment. Let us see another definition of emerging market economy. It seems very simple compared to the last one, which we have just seen. That is, emerging markets is a term that refers to an economy that experiences considerable economic growth and possesses possesses only the some, not all features, some features of what, but not all. Some features of characteristics or features or characteristics of a developed economy. That means the emerging market economies seem to be showing some characteristics of a developed economy, not all characteristics of developed economy. In that sense, you can say that emerging markets are countries that are transitioning from the developing phase to the developed phase. So developing phase to the developed phase. So they come in between. So this is emerging market economy. Okay, this is a developing phase, and this is the already developed phase. So when the country transforms itself from developing phase to developed phase, it passes through a stage of what is called emerging market economy. So simply speaking, emerging market economy is an economy that experiences considerable economic growth while transforming itself from a developing economy to a developed economy. And in other words, emerging market economies are expected to show some characteristics of a developed economy, not all characteristics. Then the BRIC, this acronym was coined by economist Jim O'Neill in 2001. And he predicted that four nations would become very predominant, and that would be reshaping the world economy: Brazil, Russia, India, and China. So that was the prediction made by this economist Jim in 2001, that four economies, Brazil, Russia, India, and China, would be reshaping the world economy, and they would become very predominant, and they would decide the course of economic growth of the world in the days to come. That was a prediction made by Jim in 2001. In 2010, the group added also South Africa, make its acronym BRICS. So it has become the BRICS, that is Brazil, Russia, India, China, and South Africa. Now, what are the characteristics of emerging market economies? The first characteristic is market volatility, market change, market variations. So emerging market economies are supposed to be experiencing market volatility. And this volatility stems from political instability, external price movements, and supply demand shocks due to natural calamities, it exposes investors to the risk of fluctuations in exchange rate as well as market performance. So first important feature of an emerging market economy is its market will be more volatile. Second is growth and investment potential. You know that these emerging market economies offer a lot of opportunities for growth and investment. Emerging markets are often attractive to foreign investors due to the high return on investment they can provide. In the transition from being an agriculture-based economy to a developed economy, countries often require a large influx of capital from foreign sources due to a shortage of domestic capital. So when this country are at a point of transforming itself from a developing one to a developed economy, it requires a lot of capital. But at the same time, it has a shortage of domestic capital. So it does not, the country may not have its own capital. So therefore, it is in dire need of capital from outside. And therefore, the country will be forced to offer high return on investment to attract the foreign capital. And this will give more investment opportunities for the foreigners in this country. Using their competitive advantage, such countries focus on exporting low-cost goods to richer nations, which boost GDP growth, stock prices, and returns for investors. Third important feature of an emerging market economy is high rates of economic growth. Governments of emerging markets tended to implement policies that favor industrialization and rapid economic growth. So that's a general trend which we see in most of the emerging market economies. If you look at the case of China has been offering more policy relaxations for industrialization, and it has been actually fostering economic growth over the last years by introducing many policies very similar to that of a capitalist economy. Such policies lead to lower unemployment, higher disposable income per capita, higher investment, and better infrastructure. On the other hand, developed countries such as the United States, Germany, and Japan experience low rates of economic growth due to early industrialization. So these emerging economies today seem to be experiencing a high rates of economic growth to the tune of sometimes 8%, sometimes 9%. But the developed economies, the so-called developed economies or developed economies like United States, Germany, Japan, they experience a low rates of economic growth due to their early industrialization process. And fourth important feature is income per capita. Emerging markets usually achieve a low middle income per capita related to other countries due to their dependence on agricultural activities. As the economy pursues industrialization and manufacturing activities, income per capita increases with GDP. Lower average incomes also is a function of incomes also function as incentives for higher economic growth. So means emerging market economies usually achieve a low to middle income per capita related to other countries because they are depending more on agricultural activities. So these are the four important features of an emerging market economy. First is market volatility. Second, growth and investment potential. Third, high rates of economic growth. Fourth, income per capita. Then the five major emerging market economies are Brazil, Russia, India, China, and South Africa. In 2009, the leaders of Brazil, Russia, India, and China formed a summit to create BRICS, an association created in order to improve political relationship and trade between the largest emerging market economies. So what is BRICS? BRICS is an association formed by Brazil, Russia, India, and China in 2009 for creating a political relationship and trade between the largest emerging market economies. South Africa joined the BRICS group in 2010, which was then renamed BRICS. Let us see something about each of these emerging market economies. First, we take up Brazil for discussion. And you know that Brazil's economy grew rapidly during the early 2010s at a rate of growth of 7.5%. Perhaps this is a good rate of growth as far as Brazil has been concerned. 7.5% growth rate is registered during the 2010s. Due to political instability and trade sanctions, however, the growth rate slowed down and became negative in 2016. Brazil has also experienced considerable improvements in income levels and poverty reduction in 2003-2014, but changes have been sluggish since 2015 due to lower economic activity. The Brazilian economy has been affected largely by political uncertainties and lower government expenditure. However, the outlook for the country's future is very positive. The domestic economy grew 0.6% in 2019 and is expected to sustain the growth through infrastructure improvements and foreign investments, along with its reliance on agricultural commodities like soybean and coffee. That means in 2010, the Brazil's growth rate was hovering around 7.5%. That was a biggest achievement that Brazil has ever made. And because of that, the Brazil became a member of the BRICS. But thereafter, especially in 2014 and 2015, Brazil started showing certain sluggishness in its growth rate. But in 2019, its domestic economy grew by 0.6%, and Brazilian government has been very interested in inviting foreign capital to that country. And not only that, has Brazil been welcoming more infrastructure investments in that country. And because of its concentration on infrastructure investment and foreign investment, Brazil has also been named or has also been included in the group of the BRIC. Let us come to Russia. We know that Russia has been one of the major power in the world, and it was a part of the Soviet Union earlier, and driven primarily by oil exports and a rise in oil prices. Russia experienced exponential growth rate in its GDP during the period 1999 and 2008, before the global financial crisis. The transition from communism to capitalism that has been taking place since 1991 has boosted economic growth in the country through economic reforms and an export-oriented trade policy. So since the disintegration of Soviet Union in 1991, Russia has been moving towards some kind of a market-oriented economy style, and it has been actually supporting export-oriented trade policies, and that has boosted its economic growth rate in recent times. However, since 2014, Russia's economy has been negatively affected by political conflicts and trade sanctions that have been imposed by the United States, Canada, Japan, and the European Union, along with fluctuations in the price of oil, which accounts for close to 52% of Russian exports. The Russian economy grew at a rate of 1.7% in 2019 and is expected to grow faster if geopolitical tensions with trade partners like the United States, Canada, Japan, and the European Union reduce. So in short, Russia bears the legacy of the Soviet Union, but it is trying to move away from the communist way and is trying to adopt a capitalist style of development, and that has actually resulted in boosting its economic growth in recent times. And thanks to all these developments, Russia has also been recognized as an emerging market economy. Now let us come to the case of India. We know that since our new economic reforms in 1991, and we have also been witnessing fast economic growth, and because of that, we have established ourselves as an emerging market, and Indian economy has been growing steadily at a relative growth rate. It averages 7.1% the past decade, with some fluctuations due to political instability and economic reforms. But overall, 6% to 7% growth rate India has been able to achieve over the last years, although there have been some kind of oscillations because of the political instability and problems taking place outside our country. Essentially, India's long-term economic growth can be attributed to the expansion of the manufacturing and services driven by exports and foreign investment. India is also experiencing gains both in capital and labor productivity due to technological advancements and educational reforms. As of now, India is one of the largest emerging markets along with China. So India has also been means very enthusiastic in attracting more foreign investment and exporting more commodities to the outside. And despite all negativities, India has been able to achieve a 7.1% growth rate over the last years. So that's an important development. Now let us come to the case of the China. The Chinese economy has posted an average growth rate of 10% since the enactment of trade liberalization and economic reforms in 1978. So we must understand that this Chinese economy has registered a faster economic growth rate compared to other countries in the world over the last years. A double-digit growth rate has been secured by Chinese economy, and that has been much remarkable. And liberalization and economic reforms, which China initiated in the early 1980s, have actually helped Chinese economies to march ahead of other countries in respect of average annual growth rate. China's economic growth has been propelled by government spending, expansion of its manufacturing sector, and exports, specifically electronic equipment. However, the country's income per capita is still low, although only 3.3% of Chinese population lives below the poverty line. 30% of the population lives below $5.50 per day. Nonetheless, as the Chinese government focuses on increasing GDP through consumption, disposable incomes are likely to increase, leading to sustained economic growth. Now the China, so now, recently the China has started focusing on increasing domestic consumption through increasing disposable income, and that's a major development. But just before that, China was more concentrating on exports, but because of the lack of expansion of market outside China, now China has started concentrating more on domestic consumption, and for which increase in domestic income is very essential. So therefore, a sustained economic growth that China has started eyeing on in recent times. Let us come to the last country which has been added to the community of BRIC, and that is South Africa. We know that South Africa was inducted into BRIC Association in 2010 after experiencing a negative GDP growth rate in 2009 following 2008 global financial crisis. Following the financial crisis, the South African government implemented a number of policies to boost GDP through government expenditure and consumption. Economic growth in that country increased in 2010-12 before slowing down in 2012-16 and rising again in 2017. South African exports are composed primarily of commodities from mining. Therefore, export volumes depend on the prices of commodities, which are highly volatile. Fluctuations in export volumes explain part of variation in GDP growth over the last few years. Although South African GDP per capita has been increasing over time, so has the unemployment rate. Today, unemployment rate is in 2019, unemployment rate in South Africa was to the tune of 29%, but South African per capita GDP has been increasing. High levels of unemployment and crime have hindered the economy's growth and investment potential, and are issues that need to be addressed through policy reforms. But still, South Africa offers a lot of opportunities for investment, and therefore, South Africa has also been included in BRIC. And now we have the BRICS: Brazil, Russia, India, China, and South Africa as the emerging market economies in the world. So with this, we